Hey guys, Matt Robinson here, founder of the Professional Investors Guild, here with another new edition of Ask the Pig. And I'm going to answer a question here in just a moment. The question I received from one of our members, Jay Paul, was, what is the difference between transactional funding and hard money lending? And I will answer that question in just a moment. Before I do, if you're not one of our subscribers and you'd like to join our email list, we do have a link down in the description of this YouTube video in which you can join. And when you do so, we've got a couple of free gifts for you. One of them is a audio lesson called Guerrilla Marketing for Real Estate Investors. If you don't know this by now, the most important part of being a real estate investor is finding the leads. Marketing is undoubtedly the lifeblood of your business. And we teach you a little bit how to do that in this audio lesson called Guerrilla Marketing for Real Estate Investors. You also get an audio top 10 foreclosure mistakes and how to avoid them. Both of those free gifts for you whenever you subscribe. Again, the link is down in the description. Back to the question, what is the difference? This is a question from Jay Paul, one of our members. What is the difference between transactional funding and hard money lending? And they are two very different things, so I want to explain that to you because sometimes these words are used and you may come to a seminar and hear those two terms, and you definitely need to know the difference to them. Transactional funding was something that came about back when the market crashed, okay, and we had a lot of people that were doing what were known at the time as double closings. We kind of call them back-to-back closings now, but or a simultaneous closing. A double closing, I guess I don't know if there's an official definition, but some of you may be familiar with them, and a double closing basically meant that you had a buyer lined up to purchase a property that you had under contract. And so you would go into the title company and you'd sell it to your end buyer first, and you would take their funds. Let's say you're buying it for 50, selling it for 100. So you'd go in and you'd sell it to them for 100, and they would bring their $100,000, whether it was through a check or a bank or a lender, however it went, right? So they would bring their $100,000 to the table, and then you would turn around just a few minutes later and buy the property and use their $100,000 to pay your $50,000, and you would get the $50,000 difference, less, of course, closing costs. Well, when the market crashed, basically all the title companies, they originally came out with rules that said, you just can't flip houses, this is illegal, everybody was freaking out. And finally they kind of dialed it back and they go, okay, well, it's not really right for us to keep people from flipping. That's, you know, flipping houses or flipping cars or flipping potato chips like Walmart does. That's just normal everyday business. That's not illegal. So everybody backed down and calmed down and said, okay, you know, just because the market's crashing doesn't mean we can just unilaterally start changing laws. So they said, okay, yeah, you can still flip houses, but if you do, you have to fund the purchase of that property, the $50,000 that you got to pay to buy it, before you can turn around and sell it. You can't use the end buyer's money any longer. It's a little fishy, it's a little shady, and they just didn't want to touch anything that looked fishy or shady just because there was so much fraud going on. There was some shady, nefarious stuff going on in the flipping business. And so in order to avoid the appearance of evil at all, they said, hey, you can buy a house and sell it the same day, but you got to have your own funding. That birthed a new form of funding called transactional funding. And basically, for the most part, it's just one-day funding, and it's designed to give you the money you need to fund that $50,000 and then turn around and resell for the $100,000. So it's really just somebody gives you the money and loans you the money for a few seconds in order to buy it, and then you turn around and resell it. Typically the fees are around 2% of what you borrow, and there's usually a flat fee of, say, $1,950, $2,000, $2,100. You know, every transactional funder has their own rules, but there usually is a flat fee. So if you're buying something for less than $100, you're not going to pay any less than at least that $2,000. So, but it's well worth it if it allows you to get into the deal and get out of it. Now, again, transactional funding by definition is really just that you have a buyer lined up that's willing to pay more. So it's not defined as one-day funding, because it's just most of them will only do it same day because basically there's no risk in it. However, there are a few transactional funders that will do it up to a week or 2 weeks, but because the risk is so heavy for them, they charge you a lot of money to do that kind of funding that goes, you know, to a week or 2 weeks. And so a lot of times it's very difficult to find a deal where the numbers work because it eats up so much of your profit. It really needs to be used as just one-day funding, and then outside of that, if you need longer time periods, you probably need to find a private money lender. The second type of financing Jay Paul was asking me about was hard money lending. Okay, now hard money lending is completely different than transactional funding, and again, it doesn't have a firm definition, but hard money in general is just for those that couldn't qualify for traditional financing. That doesn't necessarily mean your credit's shot, though that may be one of the reasons. Sometimes, you know, some of the lenders have guidelines as far as you can't have more than 4 loans or 10 loans. Those numbers have changed back and forth over the years. But if you bump up against these things where you can't get any more traditional financing, whether that's FHA or VA conventional, and so that you can't buy any other investment properties, your only route oftentimes is going to be either private money or hard money. Hard money is basically just really expensive lending, but normally it will go longer periods of time. There usually is a time frame that there usually are shorter term loans, usually 6 months to a year. But again, every hard money lender is different. You'd have to ask them individually what they allow. And the good thing about hard money lending is oftentimes they will allow you to finance the purchase price and the repair money, but you're going to pay higher interest rates. So if you're talking 4 to 5% is the normal interest rate, you're probably going to pay 8 to 10% more than that. So, 14, 15%. I've paid as high when I first got into the market of 16.5%, plus closing costs, plus points, etc. However, even though I may have paid $5,000, $10,000 in interest, and may have had $5,000 in points, I could have paid $10,000 to get that loan. If I made $25,000 on the deal, then it was worth it, right? And so sometimes this is a leveraging tool. Now, I'm not a huge fan of debt, and I'm always going to tell people all of the pain I experienced when the market crashed was because I had too much debt. So if you're new into the business, you may be able to do maybe one hard money loan, and eventually start saving up money and setting it aside so you can start paying cash or partnering with people. I wouldn't allow yourself to get too over leveraged with too much hard money. Most hard money lenders won't allow you to do that because they're afraid of losing their money. But if they'll allow you to finance more, you still want to be cautious with it and make sure you don't over leverage yourself or put yourself in a difficult situation, because the interest is very high and you don't want to start eating up all of your profits by paying interest to a bank. However, it can be a short-term solution for you if you need to get it. Now, most of them will finance about 65 to 70% of the after repair value, and so if the after repair value is $100,000, they'll loan you 65 to 70. If you're buying it for 45, that means you can get the purchase price plus say $20,000 to $25,000 in repair money rolled into it, and it'll usually give you about 6 months to a year to get it fixed up, resold, pay them off, and take your profit. So again, it can be a solution for some of you. I would be cautious with it. Make sure you don't over leverage yourself. But transactional funding, use it as much as you need to, because again, there's really no risk. You're only having that loan, if you even call it a loan, for one day. Typically, okay, and it's a great solution for those that are trying to do double closings or back-to-back closings, whether it be short sale flips or wholesaling. And in the wholesaling game, most of you only think in terms of assignments and assignment fees. But let me tell you something, the first time you find a deal where you're going to make about a $25,000 or $30,000 assignment fee, which you should always try to maximize the money you make on each deal, but sometimes the investor you're flipping it to might get a little heartburn if they see how much money you're making. So if you want to hide what you're buying it for, and I don't mean hide it in some kind of shady way, but if you just don't want to have to deal with that with your end buyer thinking you're making too much money, which I don't believe anybody can make too much money. If you found the deal, if you marketed it, you negotiated it, you should be able to make as much as you want as long as they're okay with paying your end price. If you don't want them to see how much you're making an assignment, a lot of times a good solution to that is to go ahead and do a double closing or a back-to-back closing. Now, obviously, you're going to have more in closing costs and you're going to have to pay the transactional funder, but it may be worth it if you really feel like your end buyer is going to have a problem with how much you're making. So hopefully that answers your question, J. Paul. I appreciate it. It was a great question. And if any of you guys have questions, you can join us if you're members of the Professional Investors Guild. Remember, tomorrow night is going to be our members-only Q&A conference call where you can ask all the questions you want. I'll be on the phone for an hour. We're actually going to have a few guest panelists on the call that'll be answering your questions as well. You'll receive an email about that if you're a member. And if you're not a member, what in the world are you waiting for? This is one of the hottest real estate clubs in the entire country. People are doing deals and making money. So if you want to join, right below the link in the description here that I have for you to join our subscriber list, I'll also have a link in there if you want to learn more about becoming an online member of the Professional Investors Guild. Everybody have a great week and go make some money. We'll talk to you later.